How do you see that playing out, and what do you think that means for how specialist data like geospatial intelligence should be delivered into an underwriting workflow?
As it stands today, a lot of our traffic, probably about 90% of our traffic, is API. So we'll have systems using up workbenches or software such as Cytora. We'll get an API transaction come in that will go back into the platform, and then the underwriter would use that to make a decision. Obviously, with the advent of AI and Gen AI and people having those more kind of conversational workflows and bringing in all of the other additional richness and intelligence to that, for us, that's just another channel. Ultimately, making sure that underwriters have access to high quality curated data from the kind of the best brains and the best science in the world is still relevant and is still absolutely critical, whether you're going via a workbench, via an API, or via some sort of a Gen AI interface. So in the same way that we wouldn't kind of go out and Google, should I write this property? We shouldn't be asking Claude or Copilot or any of the other kind of tools to go out and do that for us. You need to have proper good science and proper good data to be able to kind of inform those decisions and things that you can audit and trust.
What changes commercially if an underwriter can ask at the point of quote something along the lines of, what else do I already insure in this building or this fire block or this flood catchment? And could that kind of visibility let a carrier write risks that its competitors are declining?
Yeah, I'm happy to take that one. Absolutely. That sometimes 1 to 3 month lag in terms of understanding the accumulation position is a common theme that comes back to us from underwriting teams in terms of simply they're being restricted in their ability to issue the pricing and the terms. And certainly what point of quote accumulation provides is a very strong sense check of the level of risk that's a particular portfolio and risks within that portfolio are bringing. And underwriters want to write risk. They want to find solid, justifiable, stand behind reasons why they can and should write a risk at the right price. And point of quote accumulation gives them that ability to understand what the level of accumulated risk for, let's say, exposure to a flood catchment. We manage all of those flood catchment areas, looking at return periods of 1 in 100, 1 in 200 year return period extents, and identifying what level of accumulation the existing book of a carrier has within that. So then, therefore, at a point of quote, what capacity is left within that area can be filled quite happily before hitting any limits of insurance and reinsurance. So it does both things. It enables them to write more business because it's categorically defining where the level of capacity it remains within the network, and conversely stopping overtopping limits and therefore potentially breaching your reinsurance treaty or some of your capital that's reserved behind your book.
And I guess building off a couple of the points in kind of both of your responses there. So some markets they're forced to live with natural catastrophe far more often and more severely than others. And you touched on Japan and Australia. So do markets under the most pressure end up further ahead in how they understand and use property data?
And we see many carriers right now shifting to pre-process and pre-pricing every property in the United States. And this is give them like huge ability, because when you're looking just on the policy coming through the quote system that you had and you just see the property that coming to you, it's different perspective when you look on the entire market and say, now I know like every property, what is the price that I want. It's helping you also to manage the marketing side. It's helping you to manage the sales side. It's help you to make better decisions and how you spread your exposure, how you manage your book, and everything make much more sense from your side, and you're not surprised at all. This is quite incredible, and eventually give the superpower also for the carrier and for the underwriters. Like traditionally, the underwriters, this is my second point, traditionally the underwriters have like 2 hours to underwrite the policy, especially on the commercial side. 2 hours to put a price tag on properties that worth between like $1 million to $100 million. It's almost impossible. So eventually you have to understand where immediately when you have the weaknesses of this property, when you have the strongest point of this property, you have to understand everything immediately so you can actually invest these 2 hours on to make the right decision and to select much better the policies that you want and don't want, and what is the right pricing.
There are whole areas and perils that carriers treat as effectively unwritable. They blanket them out of appetite. What are the specific factors that would tell you that a location inside one of those zones has perhaps moved to being safer and in appetite? What are the things that genuinely separate exposed property from one that just looks exposed because of where it is?
I think that the most clear example of this is in flood insurance and flood zones specifically, right? When you look at flood zones, they're really rating territories more than risk accumulation or risk zones, right? They're very political, and they're responsible. The responsible party to create those flood zones is the county. They have to do surveys to bring that data up to speed or up to date. And a lot of times they'll delay these significantly. So you end up with a lot of areas that are exposed that are outside of flood zones. And there's a lot of areas inside of the flood zone that actually have never flooded at all. And those locations inside of the flood zone that have never flooded, their first floor elevation is greater than the surrounding areas. And one of the things that we do is we provide first floor elevation. That gives, combining our data with other data sources out there, it kind of sharpens that underwriter's pencil. It exposes and opens up new markets or new properties, new policies that are going to be incredibly profitable, but look terrible to everybody else on the market that don't have that insight.
Why is this oversimplification fundamentally flawed? And how does it break down when an underwriter tries to evaluate the same peril in maybe vastly different climates?
Let's say that the industry at some point, they were having pressure from the regulator so that the companies, businesses, any activity should disclose, should report how do they adapt to climate change, the mitigation and the adaptation. And in the adaptation, it ended up being, I want to be transparent, it ended up being a checkup list. Yeah, like, oh, is there a risk of flooding? Yes, no. Is there a risk of wildfires? Yes, no. And so indeed, these risk indices, these risk scores, these traffic lights are okay for this checklist. But for underwriting real physical risk, real climate physical risk, they are not okay at all for several reasons. I remember we were having a conversation not so long ago with a guy from the European Central Bank that is very focused on climate risk, and he was saying any deterministic prediction, like a risk score, or like saying, no, it's going to be this amount of rain, or it's going to be this temperature 5 years, in 10 years, is wrong by default. Yeah. So when you use a traffic light, you are using a qualitative deterministic prediction, so it's wrong by default. Indeed, for ESG, for reporting, it was enough, but for underwriting risk, it's not enough. You need complexity. You need to embrace the complexity. You need, indeed, climate data. You need climate predictions, like the ones that we do. But we are not just delivering a number, or we are not just delivering, let's say, a qualitative view of the future, like orange, red, or 1, 2, 3, 4, 5. We are delivering a probabilistic approach. We are delivering uncertainty. We are focusing on the transparency. We are sharing the models that we are using. Let's say everything. So this complexity is what allows underwriters, or is what allows any business at some point to really measure and to really have an adequate view of the impacts of climate change, of the climate.
Finally, if an insurer successfully transitions away from generic reporting dashboards and embraces true AI-driven climate intelligence, how does that fundamentally change their confidence and capability when evaluating and pricing long-term and particularly multi-year commercial contracts?
So I believe that you always have to use the standard procedure, the historical data. So that's one of the things. But on the other, this historical data is not 100% representative. Not even because of the climate change. Let's call it the climate dynamics. Yeah, the climate is not static per se. So you need projections, or you need models of the Earth that are capable to interpret this dynamism. So that's a source of climate intelligence. Going all in with only historical data and following the traditional approaches, modeling return periods with a generalized extreme Jeff or Weibull distribution or whatever, just because of the climate dynamism, but also the climate change, will be skewed. And using only projections is kind of crazy, because it's a projection in the end. It's a projection of what we expect. Yeah, I believe that the true climate intelligence lies on the combination of both factors.
I want to talk a little bit about the opportunity then. So how does growing climate volatility and geopolitical factors, those things are shaking up global supply chains. How does that represent an opportunity for insurance to think about new applications for such data to better understand and underwrite risks?
So specifically from insurance, what I see is there's a number of areas that we're seeing the applications have a part to play in. So firstly, underwriting, this move from regional proxies to actually plot level pricing, we can now provide advanced forecast as well as near-time updates on yield or real-time updates on yield, flood, wind, fire, drought, exactly at the farm level or agri level. So from an insurer, I know the feedback we've had from other insurance companies, they haven't been able to provide products on this space before. And also historically, let's face it, there's been a low, there hasn't been as much risk in this space. We see it from the banks that, they now get defaults in this space that they never used to have because of these different things that are happening. So one, that's a new revenue stream for insurance in the underwriting space, but it also means the underwriting, can be done in a managed risk way, which is great. Then there's also portfolio risk. So we can provide things on like the baseline plus delta.
Why is real-time data, transparency and explainability more important for modern insurance carriers than simply increasing the raw volume of information they receive?
Yeah, indeed, there is always a risk of being overwhelmed with data. And of course, volume without transparency, without accuracy is just noise, and that's all. And maybe it's even better to have less volume, less data, or even no data at all coming from the providers if you are not sure about accuracy. Because if you get data, it will give you some sense of confidence, but it can create false confidence. So what we do, it's real-time data matters a lot. It's absolutely key indeed for accuracy. Just to be absolutely sure about director's name, shareholder structure, if the company is active or not, etc., etc. And it's absolutely not trivial at all to have this level of certainty. And so by doing real-time data directly from registries, we can have this level of transparency where every single piece of data can be linked back to its primary source, to its single PDF, to a picture, to an API.
On the topic of scaling and build versus buy, how does the combined value of solutions lead to a whole that's greater than the sum of its parts? And how does it allow insurers to buy key robust components and seamlessly assemble them, accelerating their transformation without the massive maintenance burden?
The way to see compliance is saying, okay, if we manage to do better than people, if we manage to do better than competitions, it will drive business. And that's potentially the most important message to say to people, listeners today. It's if you manage to adjust all the different parts together in a very great way, it's business value. I had someone, I think, I talk about this example just at the beginning, about someone who just plug topograph very fast way to pre-fill data in the onboarding. Right away, they are 30% of conversion rate directly. It's a neobank. For a neobank, it's 30% of business, of additional business, of acquisition costs, of lower acquisition costs. So it's direct impact on KPIs. But as I said, it's a whole process. And so it's not just topograph alone or screening alone, ID checks alone. It's a whole process. And this whole process, we see together, it brings value.
So I guess to feed into that conversation a little bit and paint the picture of why there's a necessary reframing there, what are the consistent systemic challenges that you see carriers experiencing when it comes to complex commercial underwriting and even claims, but then on from that, pricing and quoting workflows?
The other thing that I don't think we're as in touch with is that we are trained to be highly iterative in our thinking. And if you look at the way the product cycle and the regulatory cycle has trained us, it is very iterative. you put a product into the market or into your regulators for approval. Obviously, this varies dramatically by market and line of business, whether you're excess and surplus or admitted, whatever. But the fact remains, we put a product out and then we iterate on it. And we may do a complete rewrite of it and it's a whole new product, but it's actually still an iteration of the GL product we had before or the lawyer's professional liability product we had before. Even if we've rewritten it, it's fundamentally still the same thing. We've just evolved it. And it's that evolution or iteration is at the heart. Every year, the regulators put in some new regs that touch that product or the way we operate. And so we iterate and we make the system changes around that. And we don't tend to blow up any of that paradigm, whether it's our systems, our products, the way we operate, because everything in the different pieces of the business are hitting this iteration cycle. So it's very difficult to think past that and see, what if we were to clean sheet this and rethink the entire way we work with that?
Cyber has got the unique advantage of being able to mitigate losses after a policy is bound. Could you tell me a little bit about how carriers should be thinking about improving margins through post-binding intervention?
Yeah, I can definitely do that. I think I would say shameless plug for VulnCheck, but not necessarily just for VulnCheck. Find real actionable, real-time data, as real-time as you can get it. One thing that I've seen a lot of carriers moving into is proactive notification of major incidents online, especially if they know that in the original asset inventory that was provided to them, especially when they see that those things are like large-scale internet issues, or even if they're not large-scale. Let's say that you're a carrier and you have a lot of financial services organizations. If you see a ransomware campaign being carried out by a threat actor that is always targeting financial services institutions, many of our insurers, our carriers, are now pushing notifications out to their customers saying, hey, we've noticed this thing on the internet. You should be hyper aware of it. Based on the data that we had when you originally applied for your quote, we believe that you have exposure to this particular threat. You should run mitigating controls. This does two things. One, it keeps our insured safe. I think that's, first and foremost. You asked about profitability and how do you keep, margins in place. Well, this is one of the ways that you do it. You get proactive about notifying your customers that there are risks out there that you're aware of, that they should be aware of, so that 6 months down the line, when they get a claim that's filed saying, hey, this ransomware, this threat actor created some ransomware campaign and they got us and we had to pay out a ransomware claim, then they can say, well, we warned you about this and we told you that this was a major issue. Here's the evidence. Here are the receipts that we did try to get in contact with you and let you know that this is a major risk since we can't pay the claim.
So if underwriting is ultimately about understanding exposure, how does viewing risk through a spatial lens fundamentally shift our philosophy from simply knowing where an asset is located to genuinely understanding how it interacts with its environment and behaves under stress?
Yeah, knowing a coordinate is not the same as understanding a place. In conflict analysis, that's learned the hard way. A grid reference or a lat long tells you nothing about elevation, choke points, lines of sight, or what flows through an area under pressure. And the same logic applies in underwriting. Spatial intelligence asks what surrounds an asset, what flows towards it, how the terrain and environment behave when conditions deteriorate. So that shift from risk as a static label to risk as a dynamic relationship. A property exists in a physical system, and exposure is really about understanding how the system behaves under stress. Military planners have understood this for centuries and millennial insurers are just catching up.
In today's precarious adapt or fail technological landscape, the speed and accuracy of decision making are critical. Why does it matter that spatial intelligence is embedded at the point of ingestion rather than applied as a downstream research layer?
Manual spatial research introduces a couple of problems. Speed and consistency. By the time it's done manually, the decision window may have closed, and some submissions get through research while others get a quick check with no visibility at the difference. So in a time-sensitive operational context, conflict or commercial, intelligence that arrives after the decision has already been made, just an audit trail, and it's not a decision support tool. So embedding this geospatial context at ingestion means every submission gets the same quality of physical context automatically before a human looks at it. Well, in my opinion, early movers are building a compounding advantage. Better intelligence is better pricing and better risk selection and better loss experience, with each cycle reinforcing the next. And that's building, in our opinion, a genuine data moat. Late movers while they face adverse selection at scale, the risks that spatially sophisticated carriers will decline to mitigate toward those without the capability at prices that don't reflect the real exposure. So loss ratios will diverge, and by the time it's really visible in the numbers, it's already structural.